Welcome to Iron Financial, the place where we forge stronger portfolios by putting company fundamentals under some pretty extreme stress. Today, the company in the forge is Waters Corporation, ticker WAT. Now, on the surface, they just delivered what looks like a victory lap, a really solid beat on both earnings and revenue for their fourth quarter and the full year 2025. But the market's reaction? Well, it wasn't a round of applause. It was more like a sledgehammer. The stock got absolutely punished with a brutality that has a lot of investors reeling right now. So our mission today is to deconstruct this violent reaction, piece by piece. We're going to figure out if we're looking at a solid steel-reinforced foundation that just has a temporary, fixable crack, or if this is a structure that's about to buckle under a dangerous new load. Okay, let's get into it.
Look at this number. This is what shattered the calm. Almost 15% down in pre-market trading. Now, for a mature multi-billion-dollar life sciences company like Waters, a move this big isn't just a little tremor. It's a full-blown seismic event. This isn't just some nervous selling, This is a verdict, delivered by the market swiftly and, frankly, without mercy. It's the kind of drop that screams at you that the headline numbers you've been reading about are just a distraction. The real story is buried a lot deeper, and it's a story the market is clearly terrified of. Our job is to find the source of that fear. I mean, what could possibly justify wiping out billions in shareholder value before the opening bell even rings?
And here you have it. This is the core contradiction we have to solve today. It's the whole reason we're doing this explainer. On one hand, you've got the press release. The numbers looked clean, right? Adjusted earnings per share of $4.53, that's a clear beat. Revenue of $932 million, also ahead of what everyone was expecting. By every traditional metric they teach you in business school, this is a win. Management should be popping champagne. But then you look at the right side of the screen. The stock's reaction was a complete and utter bloodbath. So is the good news just hype, or is the market's fear real? How on earth does a company report a solid quarter and get treated like an abject failure? This is where the market stops looking in the rearview mirror and starts staring right through the windshield. And apparently it sees a brick wall on the horizon.
Exactly. So we're going to approach this like we're structural engineers. First, we'll do a full inspection of the original building, that's the core Waters business, to verify that its steel frame is as strong as those 2025 numbers suggest. We'll check the load-bearing walls, we'll check the foundation. Then, we're going to turn our attention to the massive new wing they just bolted on. I'm talking about the acquisition of BD Biosciences business. And we'll determine if it's a seamless, value-adding expansion, or if it's a dangerously heavy liability that threatens the whole structure. Our final verdict will determine if this 15% stock collapse is a mispriced opportunity to buy a sound structure on the cheap, or if it's a blaring warning sign of a framework that is on the verge of catastrophic failure. Okay, let's start with that foundation. Before we even whisper the word acquisition, we have to isolate and analyze the core, standalone Waters Corporation. Because, look, if the original structure already has flaws, then adding more weight is a guaranteed disaster. We need to understand the engine that has been driving this company's profits for years. And when you look at it in isolation, the legacy business is a fortress. I mean it. It's built on precision instrumentation, super high-margin consumables, and these deep, sticky relationships in the life sciences and pharmaceutical industries. The numbers from 2025, they paint a picture of a business that isn't just stable, but is absolutely firing on all cylinders. Now, what's really interesting about this slide is the story it tells about operational excellence. Let's just focus on the full year 2025 numbers for a second. Revenue grew a really solid 7% to almost $3.2 billion. In this macro environment, for a company this size, believe me, that is industry-leading growth. But the crucial point, the detail that gets professional investors really excited, is the leverage you see on the bottom line. Non-GAAP earnings per share grew by 11%. See, when your earnings grow faster than your revenue, it's a huge sign of a disciplined, well-managed company. It means they have pricing power and they're controlling costs effectively. This isn't some company just struggling to stay afloat. This is a well-oiled machine that consistently converts top-line growth into pure, unadulterated profit. This is the financial bedrock of the entire bull case.
And this slide just brilliantly illustrates that the strength is broad-based. It's not just coming from one little corner of the business. Their biggest and most important end market, the pharmaceutical segment, grew by a powerful 9%. That's huge. But for me, the most beautiful number on this slide is that recurring revenues line, service and chemistry combined, up 8%. This is the lifeblood of the business. It's predictable, it's high margin, and it means their customers are locked into the Waters ecosystem. And even better, look at chemistry consumables, which grew a staggering 12%. This is the razor and blade model in action.
It tells you that the millions of dollars of equipment they've already sold are being run hard, day in and day out, which is the ultimate sign of a healthy, indispensable business. All right, fine. I'll give you that. The core business looks rock solid. The foundation is poured deep, the steel is high grade, and the engine is humming along beautifully. If the Waters Corporation story ended right here with these numbers, the stock wouldn't be down 15%. It would probably be up 15%. We wouldn't even be having this conversation. But the story doesn't end here, does it? All of this foundational strength, all of this impressive performance was completely and totally eclipsed by one single massive strategic decision. A decision so enormous, it has the potential to destabilize this entire structure, no matter how well built it was to begin with. This is where all the fear comes from. The problem isn't the original building, it's the acquisition of BD's Biosciences business. And let's be crystal clear, this wasn't just them adding a new floor. This was like taking that solid steel skyscraper and attempting to fuse another, equally large skyscraper right onto its side in midair. Management presented this deal as a strategic masterstroke, a bold move to create an unparalleled scientific powerhouse. But the market is looking at the initial stress tests, and it's not seeing synergy. It's seeing a potential structural weakness. It's seeing a crack appear right at the seams. Just look at this chart. This is precisely why the market is terrified. The acquired business isn't some small, digestible, bolt-on deal. It's now nearly half the company. The $3 billion in revenue from the BD business almost doubles the size of Waters overnight. So suddenly, the performance of that rock-solid, high-margin legacy business you were just celebrating, well, it only accounts for about 53% of the new combined company. The fate of Waters is now completely and totally tied to a business they didn't build themselves, a business with a different culture, and, as we're about to see, a business that is already showing some very serious signs of trouble. And that right there is the billion-dollar question that triggered the 15% freefall. This is the absolute core of the bear case. What happens when the massive new wing you just paid billions for starts to sag on day one? It doesn't matter how strong your original foundation is. If the new load is unstable, it compromises the integrity of the entire structure. The market isn't just worried. The market is convinced that Waters didn't just buy a new business, they bought a whole new set of complex, unpredictable problems that are big enough to overwhelm all the strength of their legacy core. And these are the specific problems, the sources of that sag. On the earnings call, management laid out a whole list of headwinds that really blindsided the BD business, with the CEO even admitting some of them crept in unexpectedly. First, you've got a material slowdown in China because of some diagnostic testing reforms. That's a major market hitting the brakes hard. Second, you have the logistical chaos from the U.S. government shutdown, which delayed critical export approvals. Third, a milder flu season, which is great for public health, but terrible for business when you sell diagnostic tests for a living. And finally, they were up against a really tough comparison from the previous year, which had included some one-time IP revenue. Now, individually, any of these might be manageable, but combined, they create a perfect storm, painting a picture of a business that is sputtering at the worst possible moment. And this slide right here shows the immediate financial damage. This is the smoking gun. Because of all those headwinds in their shiny new toy, management was forced to guide down their expectations for the first quarter of 2026. They're projecting earnings per share between $2.25 and $2.35. But look at the right. Wall Street, the consensus, was expecting $2.51. That's not a miss. That is not a rounding error. That is a chasm. This is the single number that caused the algorithm-driven sell-off. In an instant, all the good news from 2025 became completely and totally irrelevant. So the crucial point is this, and it's honestly one of the most important lessons in investing. The stock market is a forward-looking machine. It does not reward you for what you did yesterday. It values your company based on what it believes you will earn tomorrow, next quarter, and next year. The strong finish to 2025? That's the past. It's history. The weak guidance for Q1 2026 is the future. And right now, the market is pricing in that future weakness with extreme prejudice. It's assuming the worst, and it's worried that this Q1 stumble isn't a one-time issue, but maybe the first symptom of a much deeper, more persistent problem with the massive, expensive asset they just acquired.
So the damage is done. The stock has been hammered, and the crack in this new structure is visible to absolutely everyone. The question now becomes, can it be fixed? Does management have a credible blueprint to reinforce this structure, or are they just going to slap some plaster over a fundamental design flaw? This is where the story really pivots. We have to shift our analysis from the problem to the proposed solution. We need to scrutinize the plan that CEO Udit Batra and his team have laid out and decide if it's strong enough to reverse the damage and win back the market's trust.
And this right here is the single most important quote from the entire earnings call. It's incredibly telling. The CEO, Udi Batra, he isn't panicking. He's not making excuses. Instead, he's framing this massive, complex challenge as a familiar problem. He's looking investors square in the eye and basically saying, hey, I have seen this movie before. I have fixed this exact type of problem before, right here at this very company. He's drawing a direct parallel to the operational issues he inherited when he first took the helm at Waters, which implies he has a proven, battle-tested playbook ready to go. He is betting his own hardened credibility on his ability to execute another successful turnaround.
And it's not just talk. He laid out the specific tactical steps. This is the reinforcement plan. Step 1, they're implementing a centralized deal desk. Now, that is corporate speak for putting an end to undisciplined, margin-killing discounting and getting a firm grip on pricing. Step 2, a sharp focus on launch readiness for new products to make sure they hit the market with maximum impact and aren't just dead on arrival. And Step 3, they're deploying the same commercial excellence levers, things like building out e-commerce channels and aggressively attaching high-margin service contracts to every sale that were so incredibly successful in turning around the core Waters business years ago. This isn't theoretical. It's a proven strategy.
I have to admit, as the skeptic here, I like the conviction. The CEO was brutally blunt about the pricing issue, especially when it came to BD's high-quality, high-value reagents and dyes. He said, and I'm quoting directly from the call, there is zero reason why there should be discounting there. That's not a manager hoping for a little incremental improvement. That is a leader drawing a hard line in the sand. It signals that he sees obvious, correctable, operational sloppiness in the business they just bought. He sees low-hanging fruit that he believes his team can fix, and fix quickly. And the plan comes with hard, quantifiable numbers attached to it. These aren't just vague promises. For 2026 alone, management is committing to extracting $55 million in cost synergies. That's the straightforward stuff, streamlining overlapping functions, cutting out waste. But on top of that, they're targeting $50 million in revenue synergies. Now that's the harder part, cross-selling Waters instruments to BD's customers and vice versa. That adds up to over $100 million in combined value they plan to forge from this integration in the very first year. These are the concrete financial benefits that are meant to offset the initial weakness and really justify the deal's logic. But this slide really shows the heavy lifting that's going to be required. It's a tale of two completely different companies. The legacy Waters business is a high-margin beast running at an elite 31.3% operating margin. The acquired BD business is significantly less profitable, at just over 22%. So when you smash them together, the overall company's margin profile gets diluted down to about 28%. That's a big step backward in profitability. Correct. But that 28.1% is the starting point, not the destination. The entire thesis of the CEO's plan, the synergies, the pricing discipline, the commercial excellence, is to drag that 22.4% margin up over time, which will in turn lift the entire company's profitability. They've explicitly stated a long-term goal of expanding the pro forma margin from where it is now, that 27 to 28% range, all the way to 32% over 5 years. This is just the first painful step on that long road back to elite profitability. And that brings us to the final verdict. We've examined the solid core of the original structure, we've analyzed the heavy and currently unstable load of the new acquisition, we've seen the market's swift and fearful reaction, and we've heard management's confident reinforcement plan. Now, it's time to weigh the evidence. We have to decide if the market's brutal sell-off has forged a genuine, long-term investment opportunity, or if it's simply a value trap for investors who are underestimating the immense execution risk here.
So let's summarize the bull case. You have an undisputed, industry-leading core business with fantastic growth and those incredibly valuable recurring revenues. You have a CEO with a proven, documented turnaround playbook and very clear, quantifiable synergy targets for year one. And, critically, despite the weak Q1, the full year 2026 guidance is actually quite strong, projecting up to 10.4% EPS growth, which suggests they see the current issues as temporary. But the reasons for caution, the bear case, are just as compelling and much more immediate. The newly acquired business, which now accounts for nearly half the company, is already underperforming right out of the gate. That Q1 guidance miss was a massive red flag that has destroyed their credibility with Wall Street for the time being. There is enormous integration risk with a deal this complex, and importantly, they've taken on a mountain of new debt to do this, all while knowingly diluting their own best-in-class margin profile.
And this number grounds the entire risk profile in stark reality. To finance this transformative acquisition, the company's pro forma net debt has ballooned to around $4.7 billion. That is a significant financial load to carry. It dramatically reduces their flexibility for the next few years and puts immense pressure on management to make this integration work flawlessly and generate cash flow immediately. If the turnaround in the BD business falters, this debt load quickly transforms from a tool for growth into a heavy anchor, one that's capable of dragging the entire company down. The stakes could not be higher. Which brings us right back to the ultimate investor question. Is this a mispriced opportunity? Has the market, in its algorithm-fueled panic over one bad quarter of guidance, completely lost sight of the underlying strength of the core business and the credibility of the CEO's turnaround plan? Has it created a moment where you can buy a great long-term asset at a significant discount because of short-term fear? Or is the market's brutal reaction perfectly rational? Is it correctly pricing in the immense risk of a historically complex integration and a newly acquired faltering asset?
That is the question you have to answer. The market clearly sees a crack, and it is selling first and asking questions later. The CEO claims he has the blueprint and the tools to not only patch that crack, but to forge an even stronger, more powerful, combined structure. The bull case here is that this is a temporary, painful stress test that once it's passed will prove the long-term resilience of the company and handsomely reward patient investors. The bear case is that the acquisition itself was a strategic mistake, a fundamental flaw that has permanently weakened a once great company. The evidence is on the table. Now you have to decide if you believe in the blueprint.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.